Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. Okay, so I've previously started my commentaries with what was the recent major feature here on my daily chart, and that still continues to be the gapping changeover action in mid-May. This gapping action accelerated the move down, one that had been codified by the weekly key reversal down made in the second week of May, prior to the gap. However, a more recent action, not as impressive, has shown up on this daily chart, and that is the 3-day bullish morning star pattern that was formed over the Monday through to Wednesday of last week. I had highlighted this last week as a possible new pattern and one that would be influential. Before I explore this 3-day pattern and what happened since, I'd like to lay out some of the bigger picture. Going back to the big gapping action, this took out the previously highlighted congestion at 1378, a congestion that had been evident late last year as well as March in this year. This is now resistance. This move down also highlighted the March to date action as being a bearish halfway hesitation. Interestingly, the gap lower punched down right through the potential target for the bearish pattern in the 1350 area. Then 3 weeks ago, prices made the move of punching and closing below the middle time of the acute March to April bearish Andrews pitchfall, currently at 1253, which is highlighted in dark blue on my daily chart. At the same time, we saw prices punch down through and close below the 50% Fibonacci line of the April 2020 to February 2022 move at 1289, as if it wasn't even there. This had been the first support of note below the middle time. Further falls came with the market taking out the 50% Fibonacci line, the May 2019 to February 22 move at 1275, halting briefly ahead of the late last year congestion support at 1243, before last week punching down through that and closing below the December 2021 low at 1223. This was followed by the market trying even lower, down towards the combination of the descending lower time, currently at 1158, and the 2020 low at 1181. However, Tuesday last week ended as an indecisive doji cross, admittedly with a really long tail on it, but it set up the opportunity for the 3-day bullish morning doji star pattern. Since then, the market has tried to exploit that 3-day pattern with a move higher, though it has been limited with what seems to have slowed and even stopped on occasions to move back up, with the last 3 days being all indecisive spinning tops, a combination of the declining middle time and the overhead 50% Fibonacci line at 1275. This has given the action since mid-May the look of a possible V-bottom or even a small heavily obscured reverse head and shoulder pattern bottom, with a neckline on a closing basis at the 50% Fibonacci line. I'm not sure if either of these two patterns, perhaps more sure of the V-bottom, but I would keep a close eye on them just in case, especially after what's been happening today, what looks like a potential daily key reversal up. Finally, I'd like to repeat my comments from 11 weeks ago when I addressed some possible answers on what would be next by looking at the longer term charts, and I quote, "The possibility that we now have had a February 2021 to date bear flag, this has set up the opportunity. It would very much now depend on two factors. Will the market halt at the congestion at 1378 that had formed the lower trend line of the descending triangle from late last year? And if not, will it halt at the July 22 low at 1304? If the answer is no to both, then we may well have a bear flag formation with potential down as far as the 1120 zone. Quite a big move if it does come about." End of quote. Come a long way towards seeing that second potential down in the 1120 zone, but we're not anywhere near yet at the moment. However, there is the one other point I'd like to raise again, and it is something I've spoken about now for a few weeks. On the longer term charts, I'd highlighted the 5-year moving average, currently at 1180. I pointed out last week that this, along with the descending lower time and the 2020 low, is the reason we are seeing for the first time since mid-May some hesitation and possible aversion from going lower. It is worth keeping a close eye on these three. and especially on today's action. Chicago soybean meal. I feel obliged once again to start this commentary noting the monthly key reversal down here in March. This was the key and the start of what has been the most recent move lower. The bigger picture here, well, that has for months now had different patterns crashing in and out of each other. The biggest pattern here has been the May to date, seemingly broken, then repaired, then apparently broken again, ascending expanding wedge pattern. A huge pattern that I had pointed out many months ago. It was never a perfect pattern by any means, but it is finally working. To assist in seeing this pattern, I highlighted it here on my daily chart in dark blue, but the upper trend line is now slowly exiting top left on my daily chart. However, it's worth noting that the lower trend line of this pattern is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern, currently at 424.90. The break lower in May below this trend line and neckline combination from this, let's be honest here, from this huge pattern indicates a potential primary target still well off the bottom of my daily chart at the incredible 324 zone, and a secondary harder to reach, much harder to reach, target in the 283 zone. These are the ones you can write in the back of your diary and maybe look at once or twice a year. However, there was a nearer, more immediate pattern or patterns to look at. To start with, we had a bearish halfway hesitation formed over mid-April to late May. This had a target in the 390 zone. Last Tuesday, the market reached that target. This move lower punched down through some significant supports, consisting of the 50% Fibonacci line of the August 2020 to March 22 move at 390 even, the 2022 low at 386.30. However, whilst the market closed below the former, prices did not manage to close below the latter. Instead, over the first 3 days of last week, the market formed a bullish morning star pattern. This was the first bullish pattern since early May. However, the exploitation of this bullish pattern has not really been there, with intraday patterns countering each other to, as of yesterday, the 4th degree, and prices not even managing to move up to the 50% Fibonacci line overhead at 403.60. I said last week, and I quote, "I cannot tell as yet whether this is a relief rally after so many weeks of declining or whether it is a true bottom." End of quote. This is still the case, though I am siding more towards the relief rally idea rather than a true bottom right now. One final point, and something I know also only noted last week on my long-term monthly charts, and that is, with less than half the year gone, 2023 is set up to possibly be an annual key reversal. If we were to close on New Year's Eve 2023 either above 471 even or under 399.10, then we'd be on. Anything in between and we'd have a lesser outside year. Right now we're looking at a possible outside year, if only just, but we still have so many months to go. Chicago soybean oil. Once again, the key pattern here, which I highlighted some while ago, is the late November 2022 to date descending wedge pattern. This is easily seen as is highlighted in purple on my daily chart, and it's currently between 50.04 to 45.78. This pattern ties in with my comments from 11 weeks ago when I looked at the longer term picture, and I said at the time, and I quote, "Looking at a longer term picture, looking at a longer term chart, and we can see a topping action in formation, though whether it is a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until the 50% absolute Fibonacci line of 43.82, end of quote. Thus it seemed then, and indeed turned out to be the case, that the market was in a bearish trajectory, moving down, more or less, within this late November 2022 to date descending wedge pattern. It's not a perfect pattern. You could hardly expect to be after over 6 months of continuous work and discipline. And we saw the first signs of cracks 3 weeks ago when the lower trend line was breached, and then again last week. However, the pattern repaired itself. But this week the market is breaching the upper trend line, of this pattern. This move higher all stems from my comments made last week when I noted, and I quote, This week's action has elements of a potential 3-day bullish morning doji star pattern, as we're also seen in beans and meal. I suspect the reason we are seeing this is because we are so close now to the 50% absolute Fibonacci line at 43.82. Below this, we seemingly have limited support at 42.65 and 41.15, and we only start seeing something significant down at the 2021 low at 40.52. However, before we start looking that far, I looked again at the longer term monthly charts, and I noted the last of the long term moving averages has been tested, breached even, but has so far held up. The rising 5-year moving average, and that's currently at 45.93, the rising 5-year moving average is ahead of the 50% absolute Fibonacci line and is something to be aware of. End of quote. This potential 3-day bullish morning star pattern turned out to be the real thing, and prices have reached or reacted higher enough that we are breaching the upper trend line of the descending wedge pattern. This is where I bring in a word of caution. I cannot as yet give an idea of targets or direction on any break. It's far too early, but I can caution you on the very high probability, due to the market being so advanced down this wedge pattern, of a false break. Please be careful. False breaks can be killers. I can, however, lay out an idea of the potential size of the break once it is confirmed. For a move higher, look for a primary move once the break is confirmed of about 17.5 cents. For harder to achieve secondary move of about 28 cents. For a move lower, look for a primary move once the break is confirmed of about 8.25 cents, with a harder to achieve secondary move of about 28 cents. However, until we have that confirmation, we overall still have the same pattern once again, and until this pattern is broken, by that I mean properly broken, not breached or dinged or some such, until it's properly broken, it will continue to show the overall bearish, larger angle of attack of this market. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.